Hi, this is Greg. One of my YouTube subscribers recently asked that I do an assessment and analyze Expedia.com stock. And it sounded like that he wanted a short-term assessment for a trade. And that's okay. I'll be happy to give an assessment of that. But I'll also give you the long-term analysis to decide whether you want to invest some of your money in Expedia. So let's go ahead and take a look at that. Now, this is a 5-year chart of Expedia.com, and it doesn't take long to see that there have been some big, sharp pullbacks, down moves right there and right here recently. We've been in a nice bull market for the last 4+ years, but still Expedia has had some nasty drop-offs, and no doubt they've missed some of their revenue targets from time to time, so just be aware of that. If you do buy into this stock, either for short-term or long-term, you could get caught up into one of these major sell-offs, so you got to be careful. Don't put too much of your money into a stock like this. Okay, so let's look at it for the short-term now. This is a 6-month chart, a daily chart. Each one of these candles represents one day, and when you see a big gap like this, what it means is one day, and you can see it in the left hand corner here, one day, July 25th, the stock closed at this price around $65 a share, and then the next day it opened up around $50 a share. So that's a big loss in one day, and if you want to get out, you have to get out down at these prices. There's no way to know that that's going to come. So you have to protect yourself by not buying too much of that stock. Now, in the last several trading days, you can see that it went down a couple days, went sideways, and it started to climb back up again. Excuse me. Now, for a trading standpoint, this is a reasonable risk. If I was going to do this trade, I would buy it right about here, where we're at now, which is just under $50 a share. And then I would put my stop below the low of this price, which is about $46 a share, so maybe $45 a share, something like that is where I'd put my stop. So I'd be risking about $5 a share in the hopes that the stock would go up to $65 a share and fill the gap. So you have a 3-to-1 risk to reward ratio on that. It's actually reward to risk ratio, because you're risking 1 to make 3 times that much. $15 a share to potentially lose $5 a share. That's a reasonable risk. The way the chart looks and the way it looks like it may climb back up and fill the gap, which eventually most stocks do, I would consider doing this trade. It's not too bad. The fact that the stock has even recovered this well in such a short period of time is actually a pretty good sign. It means investors have firmed up and like these prices down here. If that weren't the case, the stock would either go flat or even probably go down further down here. So from a trading standpoint, short term, not too bad. The trader asked, do you think it'll at least hit 54 or 55 within the next few weeks? I don't know if it'll happen that soon, but I think it has a pretty good chance of success within the next few months. Now, looking at this from a long-term standpoint, remember, stocks always in the long term follow the financials. So let's look at that. How's Expedia doing in its long-term financials? This is an income statement for each year, 2010, 2011, and 2012. So the last 3 full years. Revenue, $3 billion, $3.5 billion, $4 billion. I like that. Nice trending up there. Gross profits also trending up. I like that. That looks good. Let's go down and look at earnings. Earnings went from $421 million, $472 million, still trending up good. Ooh, ouch. What's going on here? $280 million. Big drop, about a 50% drop. Maybe 40-45% drop in earnings, profits. What's going on there? I'm not sure, but I don't like what I see so far in that. Let's try to look up here and try to analyze it quickly. Now, I'm not an accountant, You don't have to be. You just have to know a few basic things about how to look at the income statement. So let's look at profits looked good so far, and expenses you can expect to climb as revenue goes up, so that's normal. Ooh, look at that. That's a big increase. 22 million in selling expenses, general and administrative. 22 million, down a little in the next year. That's good. Big increase right there. Wow, what's going on there? I don't know. Before I would want to buy this for a long-term investment, I would want to see an increase in the earnings going back to normal where they should be, and to see that number is going down somewhere close to this number, to 20 million. Why has that big number gone up? I don't know. I want to know the answer before I buy. So for long-term investment on this, no, definitely not, until I see some improvement in the earnings and find out what's behind that increase in selling expenses. So that's my take on this stock. I would look elsewhere. Also, let's go to key statistics real quickly. It's easy just to look at the PE ratio. Well, over the past 12 months, the PE ratio has been high. 47 is pretty high for a PE ratio. But 14 is quite reasonable for a forward-looking PE ratio. That is probably after the big drop in prices over the last several days. So that is a good thing. Means right now you're probably not paying too high, and it looks like investors are reacting to that. So that's interesting. Anyway, that's all I had for this. Hope you enjoy this, and thanks for joining us.